2017, I joined the team, yeah. My life has changed completely, I'm a new man. 9 to 5, fuck it, I don't need that. I'm a forex trader, please don't ask me what my G's at. I'm a forex trader, I'm a forex trader. I'm a forex trader, yeah, I'm a forex trader. I'm a forex trader, I'm a forex trader. I'm a forex trader, yeah. Nigga, see you later. Nigga, see you later. Nigga, see you later. Yeah, later, alligator. Nigga, see you later. Nigga, see you later. Nigga, see you later. Yeah.
Hello, FX Cash Academy. Good afternoon. This is your boy FX Cash here, and it's a privilege to have each and every one of you tuned into this channel watching this video right now. I want to give a big shout out to you all guys that are watching from the UAE, those that are watching from Africa. Big shout out to you guys, those watching from Europe, wherever you're watching, wherever angle you are right now, and you've tuned into this channel. FX Cash Academy, and you're watching this video right now, I want to give a big shout out to you. Now, if you are a trader in the foreign exchange market, okay, who aspires to become successful, then this platform is the place where you want to be. Because on this platform, we're going to be making trading very simple. We're going to be breaking down forex trading, to the simplest form to your understanding that would help you to improve your trading skills and become profitable over time. Okay, and on this channel we're going to be focusing strictly on trading volatility indices. Volatility indices are the instruments that we're going to be trading on this platform. We're going to be focusing all our analysis on volatility indices, be it volatility 75 or volatility 50, 25, 10, whatever volatility it is. But we are going to be focusing basically on the volatility indices. Some time back, somebody asked me, Guy, why do you love trading volatility indices a lot and you don't trade currencies? Yeah, I used to trade currencies before and I stopped trading currencies. I stopped trading indexes, okay, also simply because I am the kind of person who loves excuse me, I am the kind of person who loves to trade 7 days in a week. Okay, I love it that anytime I get on my chart, I can identify an opportunity and I can get into the market. I don't love being affected by weekends. Okay, so that's one of the reasons I love trading volatility indices, because volatility indices are open. The volatility indices market is open from Monday to Sunday, 24 hours a day. So there is never going to be a time that the market would be closed for me. Okay. And secondly, I am somebody who do not love being affected by fundamental analysis. Okay. I don't like having to go to an economic calendar to watch fundamental events, that may come up and that may affect a particular currency that I would love to trade or something like that. Okay, I don't love being affected by fundamental analysis. And with volatility indices, I am not afraid because they are not affected by any third party, or say fundamental analysis whatsoever, as it is the case with trading currencies and the other stuff like the NASDAQ, the US 30 and stuff like that. And again, one of the reasons I love trading volatility indices is because if you have the basic knowledge of technical analysis to your fingertips, then Guy, you are ready to go. Okay, you are ready to go with volatility indices. You can trade volatility indices very well with simple strategies, with your simple technical analysis strategy. Okay, and but one of the things that a lot of traders always get it wrong when it comes to using technical analysis is at the level of their entries. Okay, at the level of their entries, a lot of traders would do very good analysis, draw out they will be able to identify support and resistance areas, they will be able to identify demand and supply zones, they will be able to draw their support and resistance, draw their trend lines, okay, but they always have one particular problem, and that problem is with their entries. Okay, they always don't know what time is right for them to enter in the market, whether to place a buy or a sell. Okay, most of the times they enter into the market or they open a trade, okay, and set their stop loss, and before they realize it, the market hits their stop loss, take them out of the market, and then start going in the direction that they had chosen to go with the market. Okay, this is as a result of wrong timing to enter the market. Okay, there are techniques that we put in place to be able to ensure that our timing getting into the market is appropriate. Okay, that our timing is appropriate. Okay. And even if the market goes against us in a while, it is never going to hit our stop loss. Okay. Not like it is 100% accurate, because there is no 100% accuracy in trading Forex. I want to be very honest with you, but at least 95% of the time, okay, 95% of the time, it is very accurate, okay, with the secrets and with the tactics that we use, okay, to determine whether it is time for us to enter the market or not. Okay, we are at 90% accuracy. So guys, without any waste of time, I want us to just dive directly, okay? I want us to just dive directly into the simple steps, okay? Here at FX Cash Academy, we have been able to break down the technical analysis procedure into 3 simple steps that would enable you to identify from your support and resistance right down into making your entries and placing your stop losses, okay, and placing your stop losses, and also identifying your take profit zones. Okay, so we have broken down the technical analysis, we have broken down technical analysis into these 3 simple steps, very simple steps, and we're just going to go quickly into these steps. Okay, so like you can see here on our board, on our whiteboard, okay, as you can see on our whiteboard, it says 3 simple steps to profitable trading. Yes, because we have actually simplified our technical analysis strategy into 3 simple steps, and we are giving this out to you guys. Okay, we are giving this out to you guys. Now, for those of you who, might want to get a one-on-one, who might want to get, a one-on-one briefing on these particular 3 steps, you can contact us. Okay, if you look down in the description, the description area, you are gonna get our Telegram details, where through which you can write to us. Okay, and we would book a schedule with you guys. So let's just dive into it right away. So the 3 simple steps, okay, to profitable trading. The first step you see here, we say market direction. This is the number one thing that you want to do each time that you open your chart. Okay, the first thing you want to identify is, where is the market going? Okay, the market direction. Where is the market going? Remember, as Forex traders, we do not predict where the market is going. This is wrong. And this is a statement that a lot of traders make. Okay. And that is what they also do when they are making the analysis. And that's why they always get it wrong. You do not predict where the market is going. The chart that you have in front of you is a chart of information. Okay, it is an encoded information it is an encoded information that is presented to you graphically in candlesticks. All right, and you have to be able to read these candlesticks to be able to extract the information that the chart is telling you. And that information that the chart is telling you always have to do with where the market is going. It is simply telling you the market is heading this direction. And now what you want to do is position yourself in a place where the market will carry you along in the direction that it is going, not for you to predict where the market may be going and then you just start going that area hoping that the market will come there. No, it doesn't work that way. Okay, it doesn't work that way. All right, it really doesn't work that way. What we do is we try to interpret the message that we get from the chart, and then we position ourselves for the market to carry us along to where it is going, guys. So this is the first thing. And don't ever forget this thing that I just said right now, okay, that we interpret the information that the chart is telling us, okay, and then we position ourselves so that the market will carry us in its direction. It is just like you waiting for a bus to go to the market, okay, or waiting for a taxi to go to the market. You position yourself and stand in a place where the market will come, where the taxi will come and carry you along in the direction. okay, that it is going. All right. You don't want to enter a taxi that is going the opposite direction, okay, or you don't want to stand in the opposite side. You have to position yourself for the taxi to carry you along. Okay, you don't just start going and then telling the taxi, turn and carry me and go to my direction. No, because the taxi already has a direction it is going. So you have to position yourself in the direction first of the taxi. And then when the taxi comes, you board the taxi, and then the taxi takes you into the direction. Okay, so that is how it is. So guys, first things first, once you get into your chart, okay, once you get into your chart and you want to identify support and resistance, first thing I want to let you know is that most of us, most traders always think of support and resistance as horizontal lines. This is wrong. Support and resistance are not horizontal lines, okay? Support and resistance are zones. They are not lines, okay? We only use those lines, okay, to try to connect either the highs or the lows, okay? We use those lines to connect either the highs or the lows. So a support zone is actually an area where we have, where we have a support zone is actually an area where we have equal lows, okay, or we have lower lows. While a resistance zone is either an area where we have equal highs or lower highs. I'm going to repeat myself. A support zone is an area where we have equal lows or we have lower lows, or it can even be higher lows. Okay, while a resistance area is an area where we have equal highs or higher highs or even lower highs. That cancels completely the concept that a lot of traders have to say that, support and resistance are on horizontal line, on horizontal structures like this. And then I'm going to ask you, what about when the market is moving downward like this? How do you call these lines that you use here? How do you call these zones where you connect them with your lines? They would call them trend lines. But what they fail to understand is that trend lines are also a representation of support and resistance in a diagonal structure. Okay, so when the market is going down like this, when the market is going down like this, okay, and you draw your trend lines here, okay, connecting the lows and the highs, this one connecting your lower highs is called your resistance. It is your diagonal resistance, and the one that is connecting your lows is called your diagonal support. Likewise, if the market was going in an uptrend like this, okay, and you connect the highs here and you connect the lows here, okay, this one connecting your higher highs is still your diagonal, it is still your diagonal resistance, and this one connecting your lows is called your diagonal support. So all of these are called support and resistance. So do not have a stereotype mind saying that support and resistance are only the ones for a ranging market like this, moving on a horizontal structure like this. No, support and resistance are not just the identification of highs and lows on a horizontal structure. They are also the highs and lows of a downward moving market or an upward moving market, which are identified by the use of trend lines. Okay, so that is something that you really want to have. That is something that you really want to have at the back of your mind. So now, first things first, when we start analyzing our market, we want to go to the daily time frame first to see the overall direction of the market. Okay, we want to know the overall direction of the market. All right. Sometimes we might not get a clear pattern to see the overall direction of the market on the 4 hours time frame and on the 1 hour time frame. So that's why we started off with the 4 hour with the daily time frame to see the overall direction of the market. And usually when I go to the 4 hour to the daily time frame, what I want to do is I want to identify if the market is moving in a trend, if overall the market is moving in a trend, okay, or overall the market is ranging on the higher time frame. All right, that's what I want to identify. So I want to get a long-term trend, either a ranging structure or a downward or a diagonal structure. That's what I want to get on my daily time frame. When I talk of a ranging structure, I'm talking about if the market has been moving, if the identification of my highs and lows makes it in a way that I see the market moving horizontally like this, okay? If I see the market moving horizontally like this on my daily time frame, then it means that that market has a long-term ranging structure. Okay, it has a long-term ranging structure. And if I see it moving like this, if I see it moving like this on my daily time frame, okay, on my daily time frame, then it means that that market has a long-term downward moving structure. As well as if I see it moving like this, excuse me, if I see it moving like this, going up, okay, on my daily time frame, then it means that that market has a long-term upward moving structure. And that is the first thing that I want to identify, to know the overall direction of that market so that I can position myself and take advantage of the moves towards a particular direction. And one thing again, I'm going to tell you about these three different market structures. Okay, these three different market structures is this. You know, a lot of times people say that when the market is in a ranging market, you don't take trades. Okay, you wait for the market to be in a trending market before you take trades. Okay, I'm going to disagree with you and I would explain why. Remember, our support and resistance is done from the higher time frame so that we can see the overall direction. Okay, if I have my 4 hours market or my daily time frame, okay, my daily time frame is moving like this. My daily time frame is moving like this in a range. Okay, my daily time frame is moving like this in a range. So respecting this resistance up here and respecting the support down here. Okay, if the market is moving in this manner on the daily time frame, guys, do you know the distance, or do you know how many pips this market would give in just this one move, either coming down or going up? These are thousands of pips, where you can just grab. I mean, how many pips do you need to be profitable in the market? Okay, do you know that if you can have a strategy that would guarantee you just 300 pips with volatility indices every day, you can be a millionaire in just no time? Yes, and I will show you that. I will show you that. So, guys, you don't even need to catch all this move. Okay, you don't need to catch all this move. You don't need to catch all this move. You can catch just a portion of this move. You can catch just a portion of this move. Okay, you can catch just a portion of this move and still be profitable. But the most important thing is you want to position yourself in the direction of the move and not against the move. Okay, I would not advise that you trade ranging markets in the lower time frames like 5 minutes, 15 minutes, okay, and even 30 minutes sometimes. But I would be confident enough to trade ranging markets in 4 hours time frames and in daily time frames, because I have an entry strategy that I put in place, you know, to determine whether or not it is time for me to get in the market. Okay, whether it is time for me to get in the market. And I'm going to be revealing all of that to you guys. I'm going to be revealing all of that to you guys. All right. So first things we have said, you want to do your analysis for support and resistance on a daily time frame or your 4 hours time frame. Okay, your 4 hours time frame. And then sometimes, you know, if you just really want to scalp some few pips on the 1 hour time frame, but all of this doesn't really matter. All of this is really not the key thing here. Okay, guys, this daily time frame, 4 hour time frame, 1 hour time frame is really not the key. The key is your entry. Okay, the key is your entry. What are the conditions that you put in place that you consider before you make an entry? Okay, it is not just that prices at a resistance and you just bump into the market to take a sell, or prices at a support and you just bump into the market to take a buy. No, that would destroy your account. If you think that at all times when market reaches a resistance, you just put a sell, and anytime when it reaches a support, you just put a buy, no, you're going to destroy your account. Okay, you're going to destroy your account. So let me reveal to you the right way we use support. We use support and resistance. Okay, the right way we use support and resistance is this. First things first, when we go to our daily time frame and we have identified a structure, okay, we have identified a structure, or probably say we have identified a trend, okay, what we want to do is, let's say, for example, on our daily time frame, or on our 4 hours time frame, or even on our 1 hour time frame, we identify that the market is moving in a range like this. Okay, we identify that the market has been moving in a range like this, in a range like this, moving in a range like this, in a range like this, in a range like this. Okay, what is our interest in such a market? Our interest in such a market is only when market hits our resistance and when market hits our support. Whenever market is in the middle here, it doesn't concern us. Okay, we don't do anything. We don't do anything. That is for 1 hour time frame. This is for 1 hour time frame, H1. Okay, for H1. If I am trading a ranging market on 1 hour time frame and I notice that I made my analysis and I realized that the market is ranging like this on my 1 hour time frame, my interest would be when price reaches up here or when price reaches down here. When price reaches up here or when price reaches down here. If I see that price is in the middle of any of this, I don't take any action until price reaches down here. And then for 4 hours time frame, this secret that I'm giving you is going to be very, very helpful. For 4 hours time frame, guys, in the 4 hour time frame, if I realize that my market is ranging, if I realize that my market is ranging on the 4 hours time frame like this, okay, 4 hours time frame going up, coming down, I realize that it has been moving in a range. It has been moving in a range like this. My interest still, number one interest would be when the market hits here, 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 okay? My number one interest would be when the market hits our support and resistance. But now on the 4 hours time frame, when the market hits here, okay, and it is already going up, and I meet this market that it is already halfway here, but it is going up to hit this resistance. Now I can start identifying little structures from my lower time frames in the middle here. Okay, I will start identifying little structures in the middle here that will permit me to continue riding this market to the upside. Remember, on my 1 hour, I don't do that. On my 1 hour, I limit myself to do my entry analysis only when price hits the support and the resistance. But on the 4 hours, okay, on the 4 hours, when I see that price is already at the support and is going up, I am also still interested in seeing the patterns that are created alongside as the market is going upward, so that I can keep putting some more entries. Or if, for example, I came late when the market hit our support and already started going up, and I came late, now I'll be interested to see the kind of structures that are being formed alongside here that would permit me to continue riding that market to the upside. Okay, it is the same thing if the market was on a downtrend. If the market was on a downtrend or on an uptrend in your 1 hour, 4 hours time frame, it is the same concept. Okay, I will not be interested in trading anything on my 1 hour time frame, okay, on my 1 hour time frame trend structure, unless price is at the top or at the bottom, at the resistance or at the support. But on my 1 hour, on my 4 hour time frame, I will be interested, okay, I will be interested to see not just that price hits the support and resistance, but I would also be interested at looking at the structures, at the patterns that would be formed alongside as the market is either coming down or it is going up on my 4 hour time frame. Okay, so that is the way I make analysis when it comes to support and resistance. And when I'm talking about these structures that are formed alongside, what do I mean? For example, let me give you an example here. Let us say that we are on 4 hours time frame, okay? We are on 4 hours time frame, like you see here, and the market is here. Okay, the market is here. And probably we came when the market was already somewhere. We came to the chart when the market was already somewhere around here. But we already, from history that we see behind, okay, we already know that this market is probably going up to hit this area. Okay, going up to hit this area. What I would be interested in is that as this market is going up, remember the market doesn't just go up in a straight line. The market goes up in waves. Okay, the market goes up in waves. When the market is going up from this low point, it probably does something like this. This is the way it goes up. It is probably doing something like this. This is the way the market goes up, okay, in waves. It goes up in waves. And then at a particular point in time, the market would contract. It will contract coming back to the downside, okay? It will contract like this, coming back to the downside. But remember, this is not a reversal. This is not considered a reversal. This move here is not considered a reversal. This one here is considered an impulse move. Why is it an impulse move? Because the movement now is to the upside, and because it is coming from a support, the movement is to the upside. So every move, the impulse, there's going to be a lot of impulsiveness in the movement to the upside. There's going to be a lot of autonomy, a lot of power, for this market to move to the upside. All right. So whenever we see the market moving in this manner, and then it is coming down at a particular time, that is just what we call a retracement. Okay, that is a retracement. And now what you want to do in such a market is every time you have the impulse move, okay, every time you have the impulse move, and then now we have the retracement doing like this, we want to identify if that retracement is giving us a small structure like this. If that retracement is giving us a small structure like this, we identify it with our little trend lines. And what are we waiting to see? We are waiting to see this market break out of this trend line, or of this small trend that we identify, to the upside, and then we trigger us another entry for us to keep riding the market to the upside again until it reaches another place and it starts giving again another contraction to the downside. You identify again the same thing. Okay, you identify again the same thing, wait for a breakout to the upside, it starts continue. It will do like that until it reaches the resistance, the major resistance up. Okay, it does like that until it reaches the next resistance up. The same thing for the down. For the same thing, if the market was already here coming down, and then you came halfway like here. Okay, you came halfway like here, but the market is on its way down. What you would be trying to identify in such a market, what you'll be trying to identify in such a market is the same move, the impulse moves and the contractions. The impulse move, the contractions. Because when it starts up here, it will be going down like this. It will be going down like this, okay? It will be going down like this. And then at a particular moment, it is going to contract, going back to the upside, as though it is going back to the upside. But this is not a reversal, okay? This is just a contraction. So what you want to do is you want to identify a structure. If it gives you a structure where you can have trend lines, you identify it and wait for a breakout of that structure to the downside. To the downside, this would now be your entry. If you miss entering from the top here at the resistance, if you miss entering here at the resistance up here, now this will be your next trigger. Okay, when it breaks out of this little structure, this will be your next trigger to enter and continue riding that trend to the downside. Okay, and you want to be identifying things like this on the way down until the market gets to the downside here to this support. Okay, and it's the same thing. But remember, this is only done when I am working with a ranging market on the 4-hour time frame or on the daily time frame. I don't do this thing when the market is on the 1-hour time frame. All right, I don't do it when the market is on the 1-hour time frame. So that is how we do support and resistances, okay, and trend lines. Okay, that is the way we trade support, resistances, and trend lines. Okay, now when we are able to identify our support and resistances on trend lines on our 4 hours time frame, or on our 4 hours time frame, or on our daily time frame, okay, on our daily time frame, or on our 4-hour time frame. Now remember, I want to give you now the secret of how to get the sniper entries, okay, how to get the sniper entries how to get those accurate entries at the resistance or at the support, whether it is a ranging market or it is a trending market, whether it is a ranging market or it is a trending market like this. Let me just give you guys this secret, okay? So what I have handled, what I have explained to you guys already was the step one, identifying the support and resistance, okay? So let's say this is our daily time frame or 4 hours time frame, and we have identified this support. We have identified that the market is either moving in a range like this. We identify that the market is either moving in a range like this, or the market is moving in a downward, in an upward structure like this. Okay, it's moving in an upward structure like this. Okay, and how do we know that? We know that by the kind of we know the kind of structure by the kind of highs and the kind of lows that we have in this market. You notice that we are having in this market. You notice that here we are having equal highs. Okay, equal highs and equal lows, meaning that the lows are on the same zone, okay, and the highs are on the same zone. Here we notice that the highs get higher as the market keeps pushing to the upside. And here we notice that the lows get higher also as the market keeps pushing to the upside. On the opposite of this particular market, we will notice that the market would be like this. Okay, the market would be like this, and the lows would get lower as the market pushes. The lows would get lower as the market pushes to the downside, while the highs would also get lower. So you see the highs, they will get lower as the market pushes to the downside. Okay, and the lows would also get lower as the market pushes to the downside. But notwithstanding, this is still our support and resistance. Okay, these zones are still our support and resistance, the higher highs and the lower lows. So now, guys, I'm taking you straight away into step two. How do we get our entry conditions? What are the conditions that we want to see, okay, before we can say that, okay, we are now having a buy or a sell possibility? The first things first, when we already identify our structure on the higher time frames, okay, now for entry conditions, we want to ensure that the market reaches here. Either the market is either at our support as we identified on the higher time frames or at our resistance. If the market is at our support, whether on the ranging structure or on the diagonal structure or on the upward or downward moving structure, if the market is at our resistance, then you want to try to identify what we call divergence. You want to identify what we call divergence. And if the market is at our support, we want to identify what we call convergence. Divergence is the possible opportunity for us to sell, right? Convergence is the possible opportunity for us to buy. Okay, so we are looking for divergence when the market is at our resistance, and we are looking for convergence when the market is at our support. Now, what is divergence and what is convergence? After I explain to you what divergence and convergence is, I am going to tell you how we look at them with the use of a tool that a lot of Forex traders use, but they do not use it appropriately. One, what is divergence in the first place? Divergence is when the information on our chart is giving us higher highs, but the information on our indicator window is giving us lower highs. Okay, I repeat myself. Divergence is when the information on our chart is giving us higher highs, but the information on our indicator window doesn't correspond with that of our chart by instead giving us lower highs. So they are moving opposite to each other. And how do I mean? For example, our chart is moving like this, giving us a high here, comes down, goes up, give us another high, comes down, goes up, give us another high. Okay, you notice that this is a high, this is a high, this is another high. But you notice that this high here is higher than this high here. Okay, and you notice that this high here is higher than this high here. But the immediate replication of this particular movement on our indicator window would be the opposite, meaning that our indicator window, instead of giving us higher highs as we are seeing on our chart, our indicator window will be giving us something like this. It will be giving us something like this. It will actually go up, give us a high here, which will correspond with this high. Okay, gives us a high there, comes down, okay, comes down. And then when it is going up to give us another high to correspond with this high, it does like this and then comes down and then goes up again to give us another high that should correspond with this high. It ends there and it comes down. So what do you notice? You notice that instead on our indicator window, we are getting lower highs. We are getting lower highs, while on our chart, we were getting higher highs. So you see that the market on our chart was going upward with higher highs, but the market on our indicator window is going downward, giving us lower highs. This is what we call divergence. This is what we call divergence, okay? There is an opposite in the movement of the market on our chart and on our indicator window. So this is what we want to identify. This is the first condition that we want to identify every time price on our chart is at a resistance. This divergence is an indication to us that the buyers who are pushing that market to the upside are getting exhausted and they are gradually giving way for the sellers to push this market to the downside. Okay, so this divergence is an indication that that market is about to sell. Okay, that an upward market, that a momentum or the impulse on an upward moving market is about to finish and the sellers are about to take over to push the momentum downward. So that market, if it was on an uptrend, could definitely switch and start coming to a downtrend. So that is divergence. I hope it is understood. Subsequently, as we do analysis and we shoot videos, you are going to understand a lot. Okay. Now, secondly, we also want to look for what? For convergence. For convergence. Now, what is convergence? Remember, first of all, convergence are for opportunities to buy, while divergences are for opportunities to sell, because it is an divergence is an indication that the buyers are getting exhausted and sellers are about to take over. While convergence, on the other hand, is an indication that the sellers are getting exhausted and the buyers are about to take over. So what is convergence? Convergence is when on our chart, okay, we are having convergence is when on our chart we are having lower lows, but rather on our indicator window we are having higher lows. And I would explain to you. So let's say this is our chart. This area here is our chart, okay? This area, let's say this area here is our chart. So we have on our chart, we are getting the market coming down. The market is coming down, goes up, comes down, goes up, comes down, goes up, comes down, like this. Okay, what do we notice? We notice that the lows that we get here indicates to us that this market is pushing to the downside, because if we connect our trend line, we notice that we are getting what? Lower lows on our chart. Okay, but on our indicator window, the information that reflects the immediate action on our chart will be telling us something else. The information we're going to be getting from our indicator window would rather be giving us something like this. Let me cancel a little portion of this here so that I can show you. Okay, so on our indicator window, instead of us having lower lows like we are seeing on our chart here, we are rather going to be having something like this. The market comes down, okay, and gives us a low. This low represents this low, and then it comes again, gives us another low. This low here represents this other low, and then it comes down again and gives us another low. You notice that this low here represents this low. So we notice that on our indicator window, the lows are getting lower, but on our indicator window, we notice that on our chart, the lows are getting lower, but on our indicator window, the lows are getting higher. Okay, the lows are getting higher. And then we call it convergent because it is because the market on our indicator window is moving to converge with the market on our chart. Okay, if it continues like this, the setup you're going to see on your chart is there'll be a point in time where the price in the chart is going to come down right down to the line of your indicator window down here, and then your indicator would also be at the same point. So they are going to converge. They are going to converge on this line here. Okay. So they are instead coming towards each other. The chart is coming towards the indicator window. They are coming towards each other. Whereas on divergence, they are moving away from each other. Okay, they are moving away from each other. So two things to take note of when it comes to divergence and convergence. Let's start again with divergence. With divergence, two things to take note of is that the first thing is that your chart for divergence gives you higher highs, while your indicator window gives you lower highs. Don't forget that for divergence, we are dealing with the highs. And for convergence, we are dealing with the lows. So for convergence, the two things that we have to take note of is that the chart is giving us lower lows, but our indicator window is giving us what? Higher lows. And the higher lows that we are getting is an indication, the higher lows for convergence that we are getting is an indication that the sellers who are bringing the market down on the chart are getting exhausted and buyers are about to take over that market. Okay, buyers are about to take over that market. So what is the tool that we use, or the indicator that we use, okay, to identify these divergences and convergences on our chart? The tool that I use, which has proven to be so efficient and effective for identifying divergence and convergence, is no other tool but the MACD. It is no other tool, guys, but the MACD. Yes, the MACD. A lot of you guys know about the MACD and you have been using the MACD. Okay, a lot of you guys have been using the MACD, but you use it the wrong way. They use the MACD to either look for overbought market and oversold market. Some people use the MACD crossing to say when it is crossing below the how do they call this? Below the bars or below the middle line, it means it. When it cross going up, it means buy. When it cross going down above, it means sell. No, that's not how we use the MACD. We use MACD. MACD is a momentum indicator. MACD is a momentum indicator. And as a momentum indicator, it indicates to you when the momentum of buyers and sellers are switching. When the momentum is in the hands of the buyers, the MACD will tell you that momentum has switched from sellers to buyers. And when the momentum is about leaving the hands of the buyers into the hands of the sellers, the MACD would indicate to you before the market even switches. So we use divergence and convergence for possible sales at resistance. As you can see here, I clearly put it there for possible sales at resistance. That is for divergence. And for convergence, we say for possible buys at support. So you want to do this only when on your higher time frame price has hit your resistance or your support. That's when you now go to look for convergence and divergence. And where do we look for convergence and divergence? It is also very important. What time frame do we use to look for convergence and divergence when our higher time frame has hit support and resistance? Very important. I made a mistake and I didn't include it here, but I'm just going to include it here right now. Okay, so here we want to look for our divergence and convergence in the M1, guys. Very important. M1 or M5. Yes, that's where we look for divergence. Okay, either on our 1 minute time frame or on our 5 minute time frame. Very important, guys. Very important. Remember, I said it is for a sniper entry. Okay, it is for a sniper entry. It doesn't mean that divergences and convergences doesn't happen on 15 minutes, 30 minutes. They happen. Okay, they happen. But before you catch it, the market would have given a big move already. And for the place of your stop loss, you will need to have a huge capital to respect the zones of stop loss for the higher time frames. That's why we go to the lower time frames so that we catch it when it is still very early. And it gives us a very low risk, a very, very low risk level. Okay, but a very, very high risk reward ratio when we go to look for these divergences and convergences on the lower time frame, guys. I am going to reveal all of this to you. And remember, again, the tool that we use is called the MACD. It is the MACD tool that we use. Okay, it is the MACD tool that we use. So how would the MACD tool be set up? I know that's going to be the next question. What is going to be the settings of the MACD tool? I know that a lot of you would have questions that you want to ask. Okay, a lot of you have questions that you want to ask. I would really appreciate that if you have questions to ask, you ask your questions in the comments area. You can type comments on the comment area of this video, ask your question if you don't have clarity, or you can contact us directly on Telegram. Contact us directly on Telegram, okay, and we would give you clarity on your questions. And guys, I really want to solicit with you all that, let us keep the comment area of these videos strictly professional and cordial. Let us not comment with hate speeches, and let us not make provocative statements. It wouldn't help any of us. At FX Cash Academy, we are committed to helping guys become successful in their trading. Okay. And we want to make sure that we empower at least 5,000 people before 2022 runs out. So you want to help us achieve that goal. Okay. There are a lot of youths out there that are suffering. They can't even go to schools no more. There are no jobs. And this is a skill that we want to give out there for many people to become successful if they cannot find jobs. Okay, a lot of them have mobile phones, smartphones they can use to do analysis. Yes, you can do this analysis on your smartphones. Some of them have laptops. Okay, some of them have laptops. These guys help us share the links to our videos with your loved ones and friends, so that many of them would come to this platform, subscribe to this platform, and would also grab this knowledge that we are giving out. Okay, guys. So let's get to the MACD tool. What are the settings of the MACD tool? It is not complicated at all. The settings remains the default settings. We do not adjust anything. We do not adjust anything on the MACD tool. Okay, we don't adjust anything. So the MACD tool is something like this. It appears like this. It definitely appears like this. Okay, it appears like this. It has a line. It has a line here. It has a middle line. Okay, it has a middle line, and the market usually does like this, and it has a middle line. Yeah, and then now inside here we have all these. We have these bars inside. It has bars inside here, and then it has a signal line. It has a signal line. This line, okay, at the top here is called the signal line. Okay, it has a signal line which is red, and then it has bars inside it. So everything in the MACD tool has a role to play. It has a role to play. So we use the highs of the MACD like this, these highs. We use these highs, okay, and these lows here on the MACD tool to identify convergences and divergences in the market. Okay, to identify convergence and divergence on the market. All right, and then we use the signal line. We use the signal line, which is a line that is moving on top, and which is a line. In fact, when we get to the charts, you would understand the MACD tool. We use the signal line, okay, to understand whether that market is really switching sides. Okay, and you will understand this on the chart when we would be releasing the next video. The next video will be strictly on charts. We cannot go to the charts on this particular video, okay, because it's too long already, and we do not intend posting very long videos. So we're just going to keep this video strictly to these explanations, okay? And remember, when you want to use the MACD tool, use it on its default settings. It is on its default settings. No modification on the MACD settings. Okay, you want to use it on the default settings. So again, like I said, you guys want to keep your questions and ask them in the comment section, or you want to send us a message on Telegram. Okay, you want to send us a message on Telegram to ask your questions. So when it comes to our entries, that's the first thing we do. We identify divergence and convergence. So again, the market is going up, giving us highs, giving us highs, giving us highs, okay, giving us highs. Remember, this is on the lower time frame, either 1 minute time frame or 5 minutes time frame. That's where we're doing this. Okay, so this is our chart. Okay, this is our chart giving us highs like this. And then on our indicator window, the MACD, okay, it is inside a box like this down here. It has the middle line. It has a middle line. Okay, and then you have You have the MACD has been doing like this. It has been giving highs like this as well, giving highs like this, respecting the highs, respecting the same highs that you see on the market in the same area. But at a particular point, instead of continuing to give higher highs like this, it starts doing something like this. It starts doing something like this. It starts doing something like this. You notice that these three highs, these last three highs, this one, and this one on the MACD, okay, represents these last three highs on our chart. These last three highs on our chart. And what do you notice? You notice that on our chart, we are having higher highs. The market is pushing upward. But now on our MACD, we are having what? Lower highs. The market is pushing to the downside. Are you seeing that? The market is pushing to the downside. Now, this is a first step for a sell that we have seen. Okay, this is a first signal for a sell that we have seen. So at this point, we will tell you guys, get ready for a possible sell. Okay, get ready for a possible sell. All right. And then what will now be our entry trigger? What is now going to trigger our entry? Okay, what is now going to trigger our entry is this. We call it here breakout for entries. Okay, you see it here under step 2, breakouts. So what is the breakout all about? Breakout is actually when price breaks out of a particular pattern that it's been forming. So like, for example, here we have identified divergence. Okay, there is divergence here because divergence is for sales. Okay, and probably identifying this divergence price is at a resistance. And this resistance is actually the resistance we identified on our higher time frames. So as price is approaching that resistance, it starts giving us divergence. All right, it starts giving us divergence. Now, what do we do before we actually get to our sell? What we want to do is we want to have a pattern here. We want to identify this pattern here. We want to identify this structure up here with our trend lines, okay, touching the tips of the candles that are giving us the structure up here. And our entry is going to be what? Our entry is going to be the breakout of this structure. So when the candle that breaks out of this structure, you see a significant break and it closes out of this structure, this here would be your entry. When that candle closes out of this structure, breaks this trend line, this support trend line, and then closes out, this would be your entry. Okay, this would be your entry. So our entry is only on breakouts. Okay, the market would come, hit here, go back up, hit here, go back up. At some point, it might hit here and start consolidating inside here, consolidating, and then until it finally breaks and you see a significant breakout of that structure and the candle closes outside, that would be your entry. Okay, that would be your entry. So first things first, what did you identify? You identified a divergence. Okay, divergence doesn't mean entry. No. If you want to follow divergence to enter, you can enter very early and get out, and they kick you out of the market. Okay, because if you enter here at the top here, okay, the market might still come, respect this area down here, and then come back up again to give you another high up here. Okay, which this one on the indicator window, it will do like this. Come and give, the high might be significantly low now. See, just like that. Okay, so you don't want to enter up. Okay, you want to enter at the break of this structure. The break of that structure tells you that the sellers have finally taken over that market. Okay, so this would be your entry at the break. And then now we come to the third step. Step 3, stop loss and take profits. Validated take profit zones and validated stop loss position. In this market, whenever you enter a trade, the first thing that comes to your mind is, where will I place my stop loss? Very important. Now, remember, any strategy that does not tell you or does not give you a place, a validated place where you can place your stop loss and validated zones where you can take profit, that strategy is bullshit, believe me. Because stop loss and take profit zones are not by gesture. You don't guess. You don't make, they are not by guessing, sorry. You don't make guessings to say, okay, I just I will just put my take profit here and I'll just put my stop loss here. No, they have to be accurately calculated based on the structures that the market is giving you. And with such a strategy, okay, when you have this breakout, guys, where would your stop loss be? Your stop loss would be the previous high, and this is the previous high. This area here is the previous high. So your stop loss would definitely be above this previous high. So you're going to put your stop loss just above here, okay. And now you also understand why we do this entries conditions technique on 1 minute and 5 minutes time frame. Why we don't do it on 15 minutes and 30 minutes and all the rest. We do it on 1 minute and 5 minutes. This is because when you calculate the distance now from your stop loss to your entry position, it is significantly low in terms of pips compared to if you were doing this thing on the 15-minute time frame. Because oftentimes, almost all the times that I enter my trades using this technique. When I calculate my stop, when I calculate the pips, when I calculate the risks, okay, which is the distance from my entry position and my stop loss, it never exceeds 300 pips. Sometimes it is just like 100 pips. Other times it can be like 200 pips, 250 pips, but it never exceeds 300 pips. It never exceeds 300 pips. And 300 pips, if you're using a 0.001 lot size on probably say volatility 75, okay, on probably say volatility 75, 300 pips can be something like $3. So you're risking $3 in this particular trade. Okay, you risk $3 in this particular trade. Risking $3 to make how much? Guys, look at this. Look at this. Your risk is just $3. Let's say, for example, you have your $10 account. Let's say you have $100 account, sorry. Okay, and you take a possible trade risking just $3, and then what would be your profit potential? Now let's go to step 3. Okay, let's go to step 3 for take profit. Okay, take profit, and let us see if you have $3 risks, or say 300 pips risks. Okay, look at your first take profit zone. Your first take profit zone now would be remember your stop loss is the previous high. Your take profit zones would be the previous lows. Every previous low would be your take profits. Remember, your first entry is here at this low here because of this breakout. So your first take profit would be this next low. It will be this next low here. And you will notice that your first take profit area is already equal to your stop loss area, almost equal to your stop loss area. So the moment price comes here, you have done what? You have already covered $3 of your risks, probably say $3 of your risk, like 300 pips. Your first take profit would always be between 200 to 300 pips. If you're using this system correctly, this strategy correctly, okay, between 200 to 300 pips. Now, once price gets to your first take profit, okay, what do? You remove your stop loss from this area and bring it to your entry point. Why are you doing that? So that you break even. This means that if this market starts going back against you and it comes back to your entry position, guys, you would have lost nothing. It would hit your stop loss at your entry position here, okay, and you would lose nothing. You would lose nothing. Your $3 would still be intact because you removed your stop loss from up here and brought it to your entry position when price already went to your first take profit area. So you wouldn't be losing anything here. And it will still even do like this. It might even still come here, get you out when your stop loss is here at this point. And then it would give you would already know that because of the divergence and this breakout, this market cannot come to this top place, which was your previous stop loss. It cannot come there. So you'll still be looking for your entries only around this area, because this market will come back here and sometimes it might consolidate for a long time around this area of your entry. But believe me, guys, it will not come to your to this area here of the stop loss. So probably you can re-enter here again. Even when it gets you out, you can re-enter here again and still place your stop loss up here. Guys, I know that this is a lot of information that I have given you, but it is worth it. I would want you guys to take out time and really go through this video again to understand the basic information that I have shared with you guys. Okay, I'm sorry that this video is too long, but it was necessary. Okay, it was necessary. I didn't want to break the 3 steps in different videos. Okay, in different videos. It would have created a lot of momentum, but I want you to have it all in one video so that you can, even if you like, you can download this and be watching it over and over. If you don't have internet connections to keep going to YouTube all the time, watch it over and over. But our next videos are going to be live examples on our charts. Okay, so that from those examples, live examples on our charts, we would go back to history. We will do analysis and go back to history and show you possible entries based on the analysis that we did, that we will do. We will show you previous entries based on divergence and breakouts on the lower time frames, and then you will understand better the concepts that we are giving it out to you here. So this here would be your first take profit, this low, and your second take profit will be the next low. If the market keeps going, the third low here will be your third take profit, and then if it keeps going down again, this other area here will be your next take profit. So the lows are acting as your take profit, while the previous high alone is acting as your stop loss. And if this was for a buy market, it would be the same thing. Okay, if this was for a buy market, it would be just the opposite of what we have done right now. Okay, it will be just the opposite of what we have done right now. So I'm going to show you a scenario for buy quickly, and then we wrap up this video. So let's say for a buy market, the market is coming down, giving you lower lows, and remember, this is now on the 1 minute or on the 5 minute time frame. That's where we are making this analysis. Okay, giving you lower lows. But on our indicator window, which we have down here inside the box, our MACD, which is our super divergence convergence indicator, the middle line is here for the MACD. It always has a middle line. Okay, we notice that here price has been doing something like this. As the market was coming down, price was doing something like this. Probably the market is coming down, price is doing something like this, giving you lower lows, and at a particular point in time, instead of giving lower lows, it starts giving higher lows like this. Okay, so you notice that from this point here, probably you will notice that this low on the chart is higher than this low. This low is lower than this low. This other low here is lower than this previous one. Okay, but here we notice that what this low here, which corresponds with this low here, this would be it. Okay, and then this one here, which corresponds with this next one, okay, is instead higher. It is instead higher than this one, and this one, which would represent this one, is instead higher than this one. If you draw your trend line on the MACD, you will notice that it will give you an upward movement like this. But if you draw your trend line on your chart, you notice that it is giving you a downward movement like this. That is convergent. For what? For a buy at what? At support. This thing would happen like this when price is approaching a major support here. If you see it like this happening when price is not on the support that you have identified on a lower time, on a higher time frame, guys, avoid that market, because that market may go up for a short time and then come back down, break, and keep going down, taking you out of the market. So you want to do that only when you have identified that that market is approaching your major support, or is doing so at the major support. So we are now doing what we have identified: convergence. That's the first thing. Convergence doesn't mean what? Entry. The second thing is what? We are now going to identify what? Breakout for our entry. And where would the breakout be? Where would the breakout be? We have already seen that the market is giving us lower lows, but our indicator window is giving us higher lows. Remember, for convergence, we are dealing with the lows, and for divergence, we are dealing with the highs. So for convergence, we are having lower lows here. We are having lower lows on the chart. On our indicator window, we are having higher lows. Okay, we're having higher lows, telling us that the sellers are getting exhausted and the buyers are about to take that market over and push it to the upside. So What do we want to do? What do we want to see? Excuse me. What do we want to see before? What do we want to see as our entry trigger for a buy? Once we identify convergence, we also want to do what? We want to identify a structure for a breakout. We want to identify a structure. The market would always give you a structure. Whenever there's convergence, guys, believe me, that market would always give you a structure, either on 1 minute or 5 minutes time frame. We have seen this thing happen over and over and over again, and we will prove it to you on the charts on our next video. So, guys, we have seen that convergence, and now we have a structure. So what is going to be our entry trigger? Our entry trigger is actually going to be when this market finally comes and breaks out of this structure, and you see the candle that actually breaks out of the structure has great momentum. I'm not talking of any kind of small break and tip. No, I'm talking of you really see the body of the candle closes hugely out of this structure, like here. Okay, and you see a difference in the structure and in the area where the candle closes. Now, this is your entry trigger. This is where you enter your trades. This is where you enter your trade. And when you enter your trade there, it takes us to step 3. Where are you going to have your stop loss? Your stop loss is always at the previous low. See this. I remember I told you, any strategy that does not give you precise place to put your stop loss and precise zones for your take profit is bullshit. Okay, guys. And now this one is giving you, when you make your entries to be this way, guys, you always have a very good area for your stop loss. So your stop loss will be just below this low here, below this low, and this will be your entry. And guys, this would be your first take profit here. This would be your first take profit. Now, when you look at your first take profit, you may see, sometimes you see that it is on equal highs. Okay, it is on equal distance with your stop from your entry to your stop loss and from your entry to the first take profit. So this high, this previous high here will be your first take profit. This second high, this previous high would be your next take profit, and this other high, next take profit, and so on and so forth. Okay, guys. So the moment you enter here, you enter your trade here at this breakout, and price is going up, approaching your first take profit. You remove your stop loss from down here, and you put it exactly on your, you put it a little bit above your entry here, a little bit above your entry here. They call it break even. They call it for break even purposes, so that if this market comes back down, okay, it might come, and even if it gets you out, even if it hits the stop loss that you have brought here and gets you out of the market, you will not have lost anything. And it is not even all the times that the market, sometimes it just keeps shooting and it's going up and it's going up. Okay, sometimes it doesn't even come back, but in case it comes back to your entry position, it will hit your stop loss and you will not lose anything, because you have removed your stop loss from here and protected your entry. So you will not lose a dime from your capital, but rather, because there was a divergence and there is a breakout, you will know that this market is meant to push to the upside. So you will confidently, even if the market comes down here again, you will confidently enter your trade again here at this same entry position, okay, and still put your stop loss down here. And this market will definitely subsequently push to the upside. You can hit your first take profit, hit your second take profit. Guys, this is a very simple strategy to make at least 500 pips. And when we get to the charts, I will prove to you that it is very easy to make 500 pips every day, guys. 500 pips every day. Okay, 500 pips every day. 500 pips every day. So if you were using one standard lot size in volatility 75 and you make 500 pips every day, okay, that would be $500 that you're making. Okay, that would be $500 for one trade that you open. If you're using the smallest pip size, which is 0.001, okay, guys, I'm sorry for the noise on my background. I will try to correct that next time, my positioning where I'm doing this video. Okay, so if you're using the smallest lot size and you make 500 pips, guys, just one trade, that would be $5. Just one trade, that would be $5. So let's say you had opened, let's say 2 positions, that would be $10 you would have made for 500 pips. Let's say you opened 3 positions. That would be $15 you would have made. Okay, guys, that would be $15 you would have made for 500 pips. That would be $15 you would have made for 500. You would have made for 500 pips. Okay, guys. So this is the simple strategy. This is the simple strategy we are going to be using at FX Cash Academy to analyze the charts and to probably call for entries. So guys, thank you very much. I really appreciate your time for taking out, all that time to watch this video. It really means a lot to me. And I solicit with you guys that if there is anything that is not clear, you don't understand, okay, contact us on the Telegram channel. At least on the Telegram channel, we can take our time to really explain to you, or make a schedule to even arrange and fix a one-on-one session with you so that we can help you properly to really understand these things, because it is our mission. We are out to ensure that we make traders out there successful. Okay, we make traders out there successful. And guys, I want to tell you something. Don't always trade forex just to be profitable. Always give yourself a trading plan. Give yourself a profitability target. If you have a $100, don't just say I want to be profitable every day. No, give yourself a target. Say in 1 month or in 2 months or in 3 months, I want my $100 to must have grown to at least $1,000. Give yourself such challenges and you draw a trading plan. Very soon I would update on the Telegram channel, okay, guys, that you would find below. I'm also going to prepare a trading plan to take $100 to $10,000. Okay, a trading plan to take $100 to $10,000. Okay, that you guys can follow gradually, making a particular percentage of your accounts every day. And if you are disciplined to it, guys, you would find out that it is very simple to make money trading volatility indices. So we are here to help you guys. We are here to help you. I am dedicated to help. So if you would want a one-on-one, okay, a one-on-one session, then call me. Sorry, don't call. I will not entertain calls on Telegram, but I would receive messages. Okay, send me a message and we will discuss. Okay, we will discuss how we can make it possible for me to have a one-on-one with you at your own time, where you would be available, to make you understand all these concepts personally. And we would give you the possibility to record the session that we would have with you one-on-one, where we would explain all these things to you so that it will be personalized and you can always get to it all the times, to refresh your mind. So guys, thank you very much for your time. And please, if it is your first time on this channel, please, you want to hit that subscribe button, okay, so that every time we upload a new video, you would be one of the very first people to get notified. And please don't also forget to hit the like button on this video, so that you would help the YouTube algorithm to boost our channel, so that many other people can see it and subscribe to it and also learn this skill and become profitable. Share this video too with your friends. Share the link with your friends and invite a lot of them, to always view our videos. And soon, guys, from the next video, we shall be going straight into the chat, making analysis and telling you showing you why the market went this direction, and you would see that our entry concepts were always taken into play for the market to go a particular direction. Okay, we don't want to just enter the market. We only enter the market when we see our entry conditions being played out on the chart. Okay, sometimes the market will change direction without our entry conditions playing out, but remember, you must not catch every entry in the market. You must have laid down rules that you follow. Every disciplined person has laid down rules that you follow. Okay, it is not because you're going to the market that you just want to enter any kind of taxi to go to the market. You would want to lay down your rules for the kind of taxi you want to enter. It must first of all be a clean taxi. Okay, not a very old taxi that can break down along the road. And then it must be driven by a driver who is also responsible. Okay, so you want to put out laid down principles also, when in your trading, we don't just take any kind of trades. The trades that match our entry conditions are the trades that we take. Okay, guys, and you would have possibilities like this every blessed day in the market. You would have divergence, convergence every blessed day in the market. You can have it today with volatility indices 75. Tomorrow you have it with volatility 10. The next day you have it with volatility 50. The next day you have it again with volatility 5. Some days you can have like 10 of them on the same day in different order volatility instruments. So guys, you want to stay tuned to this channel, and thank you very much for watching. And just stay tuned, guys, until we meet again on our next video. This is your boy again, FX Cash of the FX Cash Academy. Thank you, guys. See you all next time.
2017, I joined the team, yeah. My life has changed completely, I'm a new man. 9 to 5, fuck it, I don't need that. I'm a forex trader, please don't ask me where my G's at. I'm a forex trader, I'm a forex trader. I'm a forex trader, yeah, I'm a forex trader. I'm a forex trader, I'm a forex trader. I'm a forex trader, yeah. Nigga, see you later. Nigga, see you later. Nigga, see you later. Yeah, later, alligator. Nigga, see you later. Nigga, see you later. Nigga, see